In the United States, public and private pension obligations run into the tens of trillions of dollars. That number is rarely discussed directly. Instead, people are shown funding ratios, charts, and projections decades into the future. They are told the system is stable. What they are not told is what those projections depend on. Most pension systems assume long-term returns that exceed inflation, steady contributions, and decades of market stability. If even one of those conditions weakens, the math begins to fail. This is not a distant risk. It is already happening. The gap between what has been promised and what can realistically be delivered continues to widen quietly, without headlines or emergency meetings. That silence is not accidental. It is structural. Because admitting the scale of the problem would force immediate choices about taxes, benefits, and retirement age. Choices no system built on confidence can absorb all at once, so the conversation stays abstract, long-term, deferred. But the numbers don't defer. And once you understand how pension systems actually work, it becomes clear why this is treated as something you're not supposed to question. Pension systems are not savings accounts. They are promises backed by assumptions. The money being paid out today does not sit idle waiting for the future. It is invested, exposed, dependent on returns that must materialize year after year. Most large pension funds assume long-term annual returns between 6 and 8%, not occasionally, consistently, for decades. Those assumptions are not conservative, they are necessary. Without them, the math breaks immediately. Contributions alone are not enough to meet future obligations. Demographics no longer support it. Fewer workers are paying in. More retirees are drawing out. People are living longer than the system was designed for. To close that gap, pensions must take risk. They allocate heavily to equities, private equity, private credit, real assets. Stability depends on markets behaving well most of the time. Volatility is treated as a temporary inconvenience, not a structural threat. This is the core vulnerability. When returns fall short, the gap does not disappear. It compounds. Losses are smoothed. Assumptions are revised. Timelines are extended. The system survives by pushing recognition forward. As long as confidence holds, contributions continue, and markets cooperate, pensions function. Not because they are fully funded, but because belief fills the gap. Once that belief weakens, the structure becomes fragile. And fragility is not something pension systems are built to handle. Pension systems were not designed to fail. They were designed for a different world. For decades, the assumptions made sense. Populations were growing, workers outnumbered retirees, productivity rose. Markets delivered strong real returns. The system had margin. That margin is gone. Demographics shifted first, birth rates fell, workforces aged. The ratio between contributors and beneficiaries narrowed steadily. At the same time, growth slowed. Productivity gains became harder to sustain. Interest rates fell for decades, compressing the returns pensions once relied on. To compensate, assumptions did not fall fast enough. They couldn't. Lower expected returns would have forced immediate recognition of shortfalls, higher contributions, lower benefits, political backlash. So the system adjusted quietly. Return targets stayed optimistic. Risk exposure increased. Time horizons stretched further into the future. What changed was not the structure. It was the environment. Markets became more volatile. Crises became more frequent. Debt expanded across the system, pulling future returns forward. Each shock reduced flexibility. Each recovery required more risk to restore funding levels. This is the critical shift. Pensions moved from being buffered by growth to being dependent on it, from being supported by demographics to being strained by them, from absorbing volatility to amplifying its effects. Nothing dramatic happened in a single moment. No announcement marked the turning point. The math simply stopped working under the conditions the system was built for, and instead of redesigning the promise, the system chose to preserve it by pushing the consequences forward. That decision is what defines the problem today. Not corruption, not incompetence, but a structure that no longer matches reality, still operating as if it does. On paper, most pension systems appear manageable. That appearance depends entirely on assumptions. Pension shortfalls are not measured in missing cash. They are measured in projected returns. A single percentage point matters more than most people realize. Over decades, a 1% difference separates a system that appears solvent from one that is permanently underwater. Lower the assumed return, and liabilities explode overnight. Raise it, and the gap seems to shrink. without any real change in future payouts. This is how underfunding hides in plain sight. Many pension plans operate with funding levels that would be unacceptable in any private balance sheet. The only reason they persist is time. Shortfalls are spread across decades. Losses are amortized. Language is softened. What looks like stability is often just distance. Promised benefits rise on schedule. Assets do not. That mismatch does not resolve with patience. It compounds. The danger is not that the gap exists. It's that the system is designed to make the gap feel invisible until adjustment becomes unavoidable. And by then, the options are no longer financial. They are political. Once a pension system reaches this stage, technical solutions collide with reality. Raising contributions sounds simple. In practice, it means lower wages, higher taxes, or both. Workers resist. Employers push back. Participation erodes. Cutting benefits is even harder. Pensions are legal promises, not policy preferences. Reductions trigger lawsuits, political backlash, and loss of trust that extends beyond retirement systems. Raising the retirement age delays payouts, but it does not eliminate the obligation. It shifts the burden onto older workers and assumes labor markets will absorb them. Many do not. Chasing higher returns is the most tempting option. It avoids confrontation. It preserves the promise. But higher returns require higher risk, more exposure to volatile markets, more reliance on private assets that are difficult to price and slow to unwind. When that risk pays off, the system buys time. When it doesn't, the shortfall deepens. This is the bind. Every meaningful fix imposes visible pain today. Delay spreads invisible risk over time. So the system chooses delay. Shortfalls are amortized over longer periods. Assumptions are nudged, not reset. Reforms are announced, then softened. None of this solves the problem. It manages perception. The pension system does not collapse because no one is paying attention. It continues because everyone is. Every stakeholder understands that confronting the gap directly would force losses that cannot be politically absorbed. So the structure remains intact, not because it is sustainable, but because changing it is more disruptive than living with it. Delaying recognition does not benefit everyone equally. It benefits those positioned closest to the structure. Pension assets do not sit idle. They are managed, allocated, rebalanced. Fees are collected regardless of outcomes. Management contracts persist regardless of funding status. Performance is judged over rolling windows, not full cycles. As long as the system continues, the infrastructure around it remains profitable. Governments benefit from delay as well. Shortfalls pushed forward avoid immediate budget pressure. Promises stay intact on paper. Political costs are deferred beyond election cycles. Markets benefit too. Pension funds are forced buyers. They must deploy capital continuously to meet return targets. That demand supports asset prices even when fundamentals weaken. Risk is absorbed quietly. Losses are smoothed. Valuations are modeled. Liquidity assumptions are stretched. None of this requires deception. It only requires time. The longer recognition is postponed, the more capital flows through the system. The more fees are earned. The more obligations are rolled forward. This creates an imbalance of incentives. Those who manage, intermediate, or finance the system benefit from continuity. Those who depend on future payouts absorb the uncertainty. The promise remains intact. The risk shifts. Not suddenly, not visibly, but structurally. And once a system rewards delay more than resolution, delay becomes the default outcome. Not because it is optimal, but because it is profitable for everyone except the people the promise was made to. Pension systems do not fail because no one sees the problem. They persist because everyone does. The risk is well understood. By governments, by fund managers, by regulators. What is avoided is not awareness. It is acknowledgement. Openly confronting pension shortfalls would force immediate choices, higher contributions, lower benefits, explicit losses. Those choices would not be gradual. They would be visible. And visibility destabilizes trust. Pensions rely on confidence more than cash. As long as beneficiaries believe the promise will be honored, the system functions. Once that belief weakens, participation changes. Contributions slow. Political pressure accelerates. This is why language is carefully managed. Shortfalls become long-term challenges. Gaps become funding adjustments. Risk becomes diversification. Nothing is technically hidden, but nothing is framed in a way that invites scrutiny. Silence buys time. Time preserves confidence. Confidence keeps the structure standing. Breaking that silence too early risks triggering the very crisis the system is trying to avoid. Breaking it too late removes all room to adjust. So the system does what it has learned to do best. It postpones recognition. It stretches timelines. It absorbs stress quietly. This is not conspiracy. It is coordination through incentives. Everyone involved understands that the first actor to speak plainly bears the highest cost, so no one does. The result is a system that appears stable, functions normally, and pays out as promised, until it can't. And when that moment arrives, it does not feel sudden. It feels overdue. Because silence was never ignorance. It was strategy. Pension systems are not collapsing. They are functioning as designed. Payments go out, statements arrive, confidence remains intact. That is what makes the risk difficult to see. The system survives by stretching time, shortfalls are pushed forward, adjustments are delayed, recognition is softened. As long as markets cooperate and confidence holds, the structure continues. That is not stability. It is dependency. The promise does not disappear. It is preserved by assuming conditions that must hold for decades without interruption. Most people accept this because nothing feels urgent, nothing has failed yet. But someone will eventually absorb gap through lower benefits, higher taxes, or reduced purchasing power. The system never asks who that should be. It only delays the question. And that is why pension systems are not designed to be resolved. They are designed to be extended until extension is no longer possible. The promise holds, not because it is guaranteed, but because admitting what happens if it doesn't would force a reckoning the system cannot survive.